Hello, Mark Sturdy here with this week's highlights, 7 days ahead's analysis. Let's look at this summary, week of the 4th of October. Little has changed in one sense in terms of what we think are hot markets with further to go. But even though our stances remain unchanged, things have changed, and it bears some slightly closer attention. For example, looking at dollar sterling, the gilt and FTSE, we weren't taking strong stances on either of those last week, and nor are we now. I think that deserves a little further investigation because they have moved a lot. It's also worth bearing in mind that we are now bears of the S&P 500, whereas we weren't last week. But anyway, let's look at dollar sterling, which has been very much talked about. Certainly there was a very fast move. At the end of last week, we weren't great bears of it. And the reason is that if we look here, we had broken down, but that we were halfway between this level here, the resistance up at 1.15, say, and the support at 1.05. The drama of the week was that, of course, the market traded down beneath 105 very quickly and then closed a good deal higher. Closed just under here. So that, in fact, the moves were very far and very fast, but left the slight no man's land situation of sterling unchanged, which is difficult for the traders and leaves us with no strong, firm view. In short, unless the market can close beneath 105.20, we don't think there's a massive breakdown in the cable, nor unless it can break above 122.30, 121.44, that band there, do we think it's a massive buy. So we're standing aside. Equally, there were massive moves in the gilt. There was a huge surge in yields, which we see there. But we remain unconvinced in terms of trading direction because that very large surge in yield led the market up to this massive resistance here around 4%. And even though it traded well above it, it closed within that trading range. It hasn't broken the band of resistance from these prior lows. And so we're left with a market that has moved further and faster than the others, but in so doing has led itself to a position of possible great resistance and possible stability. So we're not ongoing high yield traders in the gilt, nor indeed are we necessarily keen to short it, insofar as we're still bearish of the US note and the Treasury bond and the German Bund yields. Lastly, we ought to have a quick look at the FTSE. The FTSE did come down and indeed has broken beneath this prior low. It hasn't broken beneath that one, so you could argue it hasn't totally convincingly. It closed right on the edge of this in the weekly chart, on the edge of this trading range. It hasn't totally convinced. This is today's trading, so that it closed within this band of support, the bottom of the trading range, both in the continuation chart and the December chart. In short, we're not firm bears and clear bears of the FTSE either, even though it moved quite sharply on the week, but not as much as the yield or the currency. But it did move, but it was unconvincing. So no clear breakdown there. We think the gilts have moved to a level so fast in terms of rising yield that they're now in against new resistance, and the dollar sterling didn't finally break at the bottom of its range. So oddly enough, we remain unexcited by the sterling markets in terms of clear trading, future trading prospects. The one remaining thing that we're still bearish of gold, the one remaining thing we are excited by is we're newly bearish of the S&P 500. Just look clearly at this. It's now on the week, it broke beneath this prior low. We think that's a good breakdown and suggests another leg to the bear market. How far might that go? Well, I think the standard and obvious place is 3,500. It is both half the big rally, at a 50% Fibonacci, and it is a prior high support. So I would look for a test of 3,500 and see a little below 3,500, actually 3,400, and only if that breaks would we be very bearish. Thanks very much.